years ago. And most of my investing has been in the Southwest, even when I was in the Bay Area, primarily on IT side. And then this year, as Rick and Dean know, I'm chairing the Invest Southwest Conference. And we would love to have all the angels as involved as you want to be in that conference. We think, as a general rule, we need more capital in the region, and we would love to have all the angel groups involved with all the venture groups as well.
I'm Jim Goulka from ATIF in Phoenix. We've been around for 4 years. To give you a sense of ATIF, we've done 16 companies in the 4 years and put just over $4.75 million to work in those 16 companies. I've been in this role now for 3 or 4 months, just learning the ropes of what it means to run an angel group, and intending to learn as much as, a lot more than I'm talking while I'm here.
Okay, so the way I'd like to do this is I'm gonna start off with a couple of questions for the panel, and I'd like to take questions from the audience as we go through this as well. So if you have a question, put your hand up and we'll get to you. So the first thing that's on the list here for topics is the issue about pre-money value and round size for the kinds of deals that we do. So at TCA, I'll just tell you that the average deal that we do has a round size for us of about $500,000, maybe 700,000, something in that range. And the pre-money value for companies that we tend to invest in are somewhere probably not much further north than 3 or 4 million. So when the deal's done, TCA owns about 20, sometimes 25% of the deal. So let me just ask the panel, what are your parameters for your groups?
So a typical deal for the New Mexico Angels is anywhere from $100,000 to $250,000. A typical pre-money value is anywhere from, depending on if we help start the company or where it's out, for a real early stage is $750K up to about 1.5. So you do the math, it's 12–13%. We also do, we've done one later stage deal that had $1 million worth of private equity and from angel groups out of Indiana, and then another $3 million in NHI grants. And so that was a little higher pre-money. And that's our typical deal.
So for us, we're typically a Series A investor. We like early stage. We'll go into some growth stage companies as well. Typical Series A investor, we like if the company has some type of product, even if it's in beta, maybe they have some revenues, a handful of customers. We do like to spend quite a bit of time talking with the investor, with the customers as part of the due diligence. We usually will be in a round size of, let's say, 2 million on the small side, not more than 5 million on the high side for Series A. And pre-money valuations are anywhere from about 4 to 6 million, which I think is industry average for the venture capital side.
It's almost as if there are rules of thumb here. We're seeing a lot of deals, and many of the deals that we've done have been the $3 to $4 million pre-money, and they're looking for $1 million. So it runs that way, so much so that I think some of the deals that come to us have used that as their benchmark. That, oh, if I think I need about $1 million, I'm going to do a $4 million pre. What's also interesting is that in the last couple months, we're starting to see some deals coming to us with much more substantial proposed pre-money, even some very early stage companies with $10 and $12 million pre's, and we're finding those hard to process.
So I don't see any hands up. So I guess one question I have is, I'd just like to touch on, I know we could spend the day talking about this, but I'd like to touch on how each of your groups come up with a pre-money value for a company. Is there some kind of a general metric that you follow. I mean, I can tell you what mine is at TCA, but let me just ask the question.
Sure. So we are in the process of doing education. That's one of our missions, and we do what we call an angel boot camp. And the metric that we use is that you're worth $2.5 million when you walk in the door, and you go down as you start talking. And so we really look at really 4 things that you can quantify: management, product, IP, and market, and then and put $500,000 on each one of those, and $500,000 for a intangible. And so it's like figure skating. You know, if you mess up, you subtract. And so that's the matrix, but depending on where the entrepreneur or the company is, you know, it usually moves down quicker than it moves up.
Well, we're a venture group, so I don't have to say much more to this audience. It's as low as we can get, right? I mean, to a certain extent, evaluation of a startup company is a very imprecise science, right? I see Rick doing one of these. And to a great extent, we work backwards, right? How much capital is the company going to need realistically? How big can it get? And what do we need to do to be able to make a certain multiple on our return? We just really work backwards. I think that's probably the easiest way to put it.
The closest we come to a quantitative methodology really relates to the conversation we had earlier about early exits, that with a lot of our investments being in the software space, and the notion that acquisitions are the way out of those, and that acquirers are more interested in the market that the companies have created for themselves. We look at revenues, multiples of revenues, and kind of make a judgment about a multiple of what we think might be a revenue number 5 years out, and discount it, obviously. So then the art really is in what's the revenue number going to be. And that is, if we have a group of people, it's a group of thumbs, and you figure out how high each of the thumbs are, maybe you average them, and that's the number that you get to.
Okay, so I think, yes.
Question to throw at you. What, if any, weight do you give to the founder's investments in valuation, and then particularly, A, if it's cash, and B, if it's, salary, delayed salaries?
Okay, so let me start off answering that question, because I was going to tell you all the way I do this at TCA. What I heard here were basically top-down approaches, and what I do is a bottoms-up approach, and I start with cash in. So how much skin is in the game? How much money has been invested? How much cash has been invested in the company? And that's the foundation. That's the beginning of the value. And then if a company has a grant from the federal government, you add something. You don't add the full value of the grant, because you know that 100% of the grant did not go forward, go into pushing the company forward, so you have to discount that. And then you start looking at things like, oh, do they have an issued patent that's worth something? You add something. Is it just an application? You add less. Is it U.S. only versus worldwide? If it's an issued worldwide patent, it's worth a lot more, obviously. So we tend to build from the cash in. Sweat equity doesn't count, because that was what was put in to make the company where it is today. And so if you as an angel investor want to invest to pay back the founders for putting the effort in that got the company to your doorstep, that's your choice, but that's really not pre-money value. That's where you're already looking at that, essentially. So that's my answer. I'll let the panel discuss.
Sure, if you put in $500,000, that's a floor. So we'll start moving up on that. I mean, we make this stuff up. At the end of the day, it's really how much is the valuation, and is that valuation enough to attract capital? And if it's not enough to attract capital, you got to push the value down. And Rick has a
I just want to put an input and just create an argument here. I say that it's not what the pre-money is that's really, really important for us. It's what the valuation will be. And my sort of argument with the panel is we spend a lot of money, a lot of time arguing about, is the pre-money of a particular company 1.9 million or is it 1.7, when we should be obsessed with what the revenues are going to be and what the ultimate valuation is going to be, because that's the big, mathematically that matters.
Understood, but you're just guessing.
Right,
I
we're
mean,
guessing.
the reality of the situation is you're going to have to come up with a number that can attract capital. And yeah, you can, we have great modelers at our VC firms, but it doesn't mean crap. Because I can model something that's worth $1 billion, but will I be able to attract capital today? And the answer is probably not. So while you can always look forward, you got to be it here now and work with both the entrepreneur and the investors so everybody's on the same page so a deal can be done.